The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
So today we'll cover three main points. The first point is initial donor considerations. Good, bad, or otherwise, we usually think about donating to our favorite charity around Thanksgiving or Christmas, the last month or two of the year. Usually we need a little bit more planning than that. The second point we're going to talk about is philanthropic goals and being a little bit more specific, more than throwing our loose change into the red buckets at the end of the year. And finally, the third point we'll talk about is tax efficient methods of doing this. And again, saving a few tax dollars while we feel great about giving. The initial donor considerations, we want to give to charity both a personal and strategic decision in our financial plan. And really, there's a lot of interrelated and interconnected items that we should think about. We should think about our income levels for that year, what our tax projections may look like in that year and also the years ahead. And then we also want to incorporate our estate plan. All these are interconnected and interrelated, and we should consider them all before we do our gifting. The second item we're going to talk about is being more specific with our philanthropic goals. The first one is age of the donor. There's a couple of very important ages to consider. 70 and a half. I don't know why it wasn't 70 or 71, but it's 70 and a half. And those are for what we call QCDs, qualified charitable distributions. We'll talk about that a little bit more later in our presentation. And the other age to keep in mind is 73. Right now, that's the age for required minimum distributions, RMDs, from either a 401k or an IRA. Size of the gift, again, are we just throwing some loose change into a bucket, or are we looking to fund a scholarship for several years? So that can really factor into our decisions. And then the type of donated asset. We always think of cash, but based on the next page that we're going to do, there's a lot of other assets we can give. Some of the things that we will talk about on this page, obviously cash is the most popular. The first point there, bundle if itemizing on Schedule A. What that means is back in about 2017, the standard deduction on our tax return was increased quite significantly. For 2026, for married folks, that level now is $32,000. For single, it's about half that, just over $16,000. So what I mean by that is if we're going to itemize, the sum of all our itemized deductions have to be over those two thresholds. And those are some fairly large hurdles. There's not a lot of people itemizing, but if you add up all your itemized deductions and they're bigger than that standard deduction, then your charitable contributions can help your tax return. In terms of some of the more important and main itemized deductions, it's medical expenses, home mortgage interest, a SALT limit, and then your charitable contributions. And what I mean by SALT is state and local tax. For those of us, unfortunately, in high income and real estate tax states like New York, the SALT limit used to be $10,000, but with the One Big Beautiful Bill Act, that was raised to $40,000. So depending on your income, you can use up to $40,000 for that SALT limit. If that happens, then obviously you're going to be above the standard deduction limit, and then all your charitable contributions are really going to help your tax return. Long-term appreciated stock, we're going to talk about that on the next slide. That's a great way to give. We can give vehicles, we can give real estate. Obviously, with real estate, you need some more specific planning. Non-cash items. Again, usually towards the end of the year, we clean out some of our spaces and throw the big black garbage bag into the bin and call it a day. The IRS now is becoming a little stickier with that. They want a little bit more details, who you're gifting those clothes to, what they were, where you gifted them, and what the date was. So we need to do a little bit better job on our accounting skills with that item. And then who is the gift for? This really isn't a financial decision. This is a much more personal decision, whether it's your favorite museum or your favorite church or a college you went to. Lots of different folks have different priorities. The next slide and the third point we're going to talk about today is just tax efficient methods of doing this and going from very simple situations to much more complex situations. One of the simplest items is beneficiary designations, but it's one of the most important items. And when we talk about beneficiary designations, we want to be sure we're talking about both having primary beneficiaries and also having contingent beneficiaries. So very important, because these beneficiary designations actually trump your will. They don't go through your will. There's no probate process. It's simply the paperwork that you filled out. So if you have an IRA or a Roth IRA or a 401k or 403b, please make sure that your primary and contingent beneficiaries are done and updated. A TOD, that can be for a brokerage account. What that means is transferable on death. It's simply adding beneficiary designations to a brokerage account. POD, same thing, payable on death. However, that's for your bank accounts, not your brokerage accounts. So very important, but a simple fix there and something you should review quite regularly. QCDs, charitable, qualified charitable distributions. We touched on that earlier. Have to be 70 and a half and have an IRA. The maximum amount is 111,000. And what happens in this scenario? This is a really cool situation. You can take money from your IRA and give it directly to the charity. And what it does is it skips your tax return. So none of that money that's usually taxable from your IRA gets taxed. It goes right to the charity. They get the full benefit. And a couple other things it can do is, because it doesn't touch your tax return, it can reduce your income, keep your Social Security less taxable, and also keep your Medicare premiums at a lower rate. So some good situations to take advantage of there. Long-term appreciated stock. Stock market's been very strong for the better part of a decade. If you have a brokerage account, you can donate long-term appreciated stock rather than selling it and paying all the capital gains and then giving your charity what's left over. You can give them that appreciated stock. You don't pay the capital gains tax, and nor do they. So it's a real win-win situation. The last item, donor advised funds, charitable trusts, and private foundations. These are definitely the most complex way to give. Usually a charity is going to need to be involved. They're more complex, and they're usually for larger donations. Last couple of slides, we'll talk about these briefly. A donor advised fund, or a DAF, as I said, better for larger gifts. You get an immediate tax deduction. What I mean by that is, if you're hoping to donate to a charity for 10 years and you contribute the full amount of that gift in 1 year, you get to deduct the full amount. Hopefully it's invested where it can grow and have the potential to grow, and then you decide on how you want to donate those funds. Charitable remainder trusts, CRT, it can be a CRUT or a CRAT. What that means is simply the income stream goes to the donor. When the donor passes, what's left in that trust goes to the charity. And the third point there, can be an annuity or a percentage. What I mean by that is, it can specify where the annuity can be, for example, $100 a month, or it can be a percentage. So, the income stream for the donor may be 4% a year. So it can either be an annuity or a unit trust. The reverse of that is a charitable lead trust. Now the charity gets the income, and then what's left goes to a non-charitable beneficiary, usually a family member. Again, these can be a fixed amount, a dollar amount, or it can be calculated as a percentage. The last one, most complex, most costly, definitely need an attorney involved in drawing up a private foundation. These are good for very large gifts and a lot of times multi-generational. So grandma and grandpa may want to have their kids involved. They might want to have their grandkids involved. It's a large gift, and it's going to continue for many, many years. So that private foundation is a fantastic tool. As I said, much more complex and probably something you need an attorney's help with. So that completes our presentation today. I hope you enjoyed it. Again, thank you for your time and sitting in on it. If you have any questions, please call us at 607-936-3785. We'd be happy to take any questions you have about charitable giving. Thank you.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.